In early October of 2021, the 10-year versus 5-year U.S. Treasury yield curve printed a recent high of 55 basis points, but has since collapsed down to a low near 7 basis points. Now, historically, an inverted yield curve, where longer end rates go lower than shorter end rates, has been viewed as an indicator of a pending economic recession. Now, when looking back since 1985, the 10-year versus 5-year has printed negative 4 times. Now, 2 of those times we saw very shallow inversions, but the other 2 were deeper and recessions soon followed. The point is that investors begin to seek the perceived safety of longer-term U.S. Treasuries instead of putting that money to work into other assets. Now, most analysts will also point to skyrocketing consumer costs, particularly fuel, as being a catalyst for the economic slowdown. Now, up until this point, the Federal Reserve has not backed off their hawkish tone. That's causing further recessionary concerns. Obviously, geopolitical risks are front and center, and this has broad implications, particularly as it concerns to elevated commodity prices. Now, if a trader feels that a recession is imminent and that soon the 10-year versus 5-year will invert, an example of expressing that thesis could be to sell the March Micro 10-year Treasury yield futures contract at 1.86 and buy the March Micro 5-year Treasury yield futures contract at 1.79. This constitutes selling the spread at 0.07 or 7 basis points. You could target negative 0.27, which is negative 27 basis points, which was the low last time we went significantly negative in the year 2000. A stop for this trade could be placed at 0.18, above recent highs. This trade could make $340 if your target is reached, or risk $110 if you're stopped out at your level. Now, if a trader believes that the opposite is true and that the curve has potential to steepen again, they could buy that March Micro 10-year Treasury yield futures contract at 1.86 and sell the March Micro 5-year Treasury yield contract at 1.79. This would be buying that same spread at 0.07 or 7 basis points, and a target for this trade could be placed at the January highs of 0.30 with a stop placed at negative 0.05. This trade could make $230 if your target is reached, or risk $120 if you're stopped out at your level.